will be our first quarter webinar. Our goal is to continue doing these every quarter. So, all right, that being said, I will hop in. So welcome to the Fergmar 2026 Vision webinar, everyone. I appreciate y'all spending the time with us here today. So this is just a kind of a overview of what Fergmar Capital looks like today. With the recent acquisitions, we just crossed right at 137 million in assets under management. That's based on just today's value, not any future value. Over 1,000 multifamily doors, 285,000 of just purely retail commercial square footage, and that's over 130 properties. Current asset classes, there are some other asset classes in those total numbers, but our focus right now, and you'll see from us moving forward, multifamily and then the retail professional shopping centers. On an investor front, we have 157 active investors, 214 total investments with 14.5 million investments under management. You'll see the screen over here is just kind of a little mix of our portfolio, 59% in multifamily, 39% commercial, and then 1.5 we have in just a few pieces of some development land that we've had in our portfolio for a while. So our assets under management. So, and I don't think I have this on a future slide. So with investors, I believe it's about 47 to 50 of that is on syndicated models, and then the remainder of that is our assets under management that we've acquired over the 20 years in our main corporate portfolio. So all right, a little bit more. So today, markets that we are operating in, we're in the Victoria, Texas market, obviously. And then we are looking at Sugar Land, Katy, those are the markets that we're actively in right now. Some recent achievements. So 2 major closings, as many of you probably know, that closed in Q1, the 288 unit multifamily, The Grove, and then the 36,000 square foot Grand Parkway in Sugar Land. So that Grand Parkway expanded our Houston submarket footprint there. We were already in Katy, so the Sugar Land just gave us a much bigger footprint there. Some on active, and we'll get more in depth on these on an asset by asset slide here in a minute. But we've turned over 40 units at the Post, getting about 125, average rent increase there over the first 6 months. We grew to 157 active investors. Some of the ones I see on the call, just lots of new faces and new partners. So that was very exciting for us. And then we grew to the 14.5 million in investor capital, but that's from 2022 to today. Touching on that, so the total capital is actually 14,691, and then we've distributed 1.196, with a large chunk of that distributed in 2025 with a successful refi. So it's definitely a great year. Some of the market environment we're seeing, current loan rates that we've been getting quotes on. This isn't necessarily specific to deals we've closed, but we get into underwriting, we'll source capital markets departments quotes, but we're seeing somewhere in the 5 to 6.5% range, and that highly depends on if that is small or large balance. The large balance is mostly what we're underwriting. So I think Clayton, I saw you had one come back earlier. Was it 5.15 today on a Fannie Mae?
Low fives, potentially crossing the border depending on, it seems like, the day for the most part here lately.
And I know we'd seen some sub 5 for a little bit there, but with everything going on, we've definitely seen a stall and even a little increase in some of the rates. Bridge banking somewhere in that 7 to 8.5. Most of our deals have come in right at 7 on deals where they're pricing them off of the SOFR with the spread. What we were seeing previously, agency was all the way up, getting close to 7. Bridge 9+, even double digits. So, I wouldn't say that the stall in the rates is. We haven't had a deal that really made or was going to make or break the deal. But we'll see what happens there. We've seen, some of the markets we're in, we're not in the new construction side of it, but we've definitely seen some slowdown there. So as that continues to slow in some of the markets we're looking at, it is, the more new construction, then you start seeing the specials on the Class A, it'll move into the Class B, which is kind of where we're looking. So as that slows down, it'll strengthen a lot of those markets. We've definitely seen a difference in the pipeline. That started last year. It's getting even busier and busier. And some of that's part of our expansion, just more contacts, brokers, some of the, LinkedIn social media presence we've had. We've made a lot of connections, and the pipeline's been, we're getting more than we can get through to underwrite, which is a good problem to have. So we just getting tighter and tighter on what we're willing to look at. This is just some fun facts there, or we had job growth, up 39%, new supply in Texas markets, 7%. So just some neat things to look at. Some opportunities that we're looking at. Um, you know, this is shifting daily, but a little bit less competition. There's still some people that are in. I was just talking to some people. I just got back yesterday from a conference in Colorado, and there's people that they're either they're waiting. They think that the bottom's not here, and they want to wait for the bottom. I think that's market specific, so that's everyone's opinion. And then you definitely have we have people that they realize the opportunities there, but they're still recovering from the tough few years, and they're in markets where they've seen a bunch of they're having to give more concessions. They have stuff in their portfolio that's not performing, and so there's not in a position to go and acquire. It doesn't matter if it's a good deal or not. So kind of what we're seeing there. So that's lowered some of the competition. Definitely not as competitive it was, at the height of it, 2020, 2021, which has resulted in some better pricing. More flexibility from the sellers. They're willing to negotiate more than we had seen, for quite a few years there. And the financing structures, even with some of the Pauls, on some of the rates and things that have happened, but where we were getting, you'd have really one option or two options that worked. We're getting spreadsheets of, we can pick from 15 or 20, just a lot of flexibilities that we can plug in and see what works best for the deal. So, kind of some metrics on what we're looking for. Our target deal size somewhere in the 5 to 30 million range. And that will change based on asset. Like, it shows here, we're targeting multifamily, neighborhood, retail, and professional centers. The multifamily is probably going to be, we're looking at stuff that we've underwrote 10. We have one, just had some updated financials come through, and they're at like 37 million. So, the Grove closed out, total investment there is going to be between 21, 22 million. So probably see something in that size or a little larger on the multifamily front. We are looking at some, 10, 11 million, since, we're in the Katy and Sugar Land, those Houston submarkets in the, retail professional centers. We're not there yet with multifamily. So our barrier to entry, we are looking at, some 100, 110 units, stuff that's coming in that 10, 12, 15 million range, but also looking at some 20 million range. So, and then the neighborhood retail centers and your professional centers will probably be, that's where the lower price tag will come in. We'd look at something that's a 5 million range. We're also looking at some that are 10 or 12, and that's kind of what we're looking at there. The target markets, as mentioned, is either Victoria County and then Katy and Sugar Land for sure, but really any Houston submarkets there is what we're looking at, and that's for all the asset classes. Our second pillar here, just a lot of these are standard things we do on every deal, but we're just really focusing on especially with the recent acquisitions, we're still looking at, we're still in acquisition mode, but more hyper focused on the second pillar here, putting more time there, still keeping the pipeline going, if the right deal comes along, but a lot of team focus is on the two recent closings and make sure we're maximizing all the opportunity there. So, from revenue optimization, operational efficiencies, it's something we talk about a lot for people that have been on the phone with me or watched our webinar. We look at they're overpaying for grass, the Grove had a $9,000 trash bill. So just really fixing all those inefficiencies, and trying to be more efficient there. Just really being strategic in our renovations. That's a piece. As we get into the slides, you'll see, we've kind of modified some of that from everything, getting just the full package. We want to focus on making sure it's, safe, secure. It's somewhere someone wants to call home, but maybe they don't need granite. Maybe they don't need certain things that we were putting in. So we can, save, use that cash flow elsewhere. So, then, tenant retention has been a big one. We'll cover some of these facts here in a minute, but just trying to put a lot of focus, with the on-site teams on, resident events, and Bailey will talk more on some of that. And then our renovation budget. So on our Class B, somewhere in the 5 to 8,000 range. Class C has been in the 10 to 12. Target rent increases, it's been pretty consistent. The 3 to 5% we've been consistently getting that. We haven't seen any declines. And then again, on the expense reduction, master insurance policies is something we've been big with. We're expanding our third party management. We have two great partners, one that we're using on the multifamily, one we're using on the retail professional in the Houston submarkets where we manage everything Victoria commercial wise ourselves. But the Grove was our first move into that third party management. We've got a really good partnership with them that's working well. We do some of the work, they're doing more of the day to day, but we've already seen the insurance was a good saving using their policy, and many other pieces that we're seeing things with their 40,000 doors they manage. They just have some efficiencies that are been some really good cost savings. We we made a new partnership. I guess this be our second year with the firm that disputes all the taxes for us. We're using a firm out of Houston, and we've really grown that, and saw a lot of success in that last year. So, and then on investor experiences, this is one of those. You'll see, like I mentioned, we want to do these quarterly. There's 4 of these. Setting up more property tours. We've done that, but we're going to do even more of them. Just trying to improve our communication all the way around. Little things we just implemented. Now there's an automated email every time you make an investment, and then as we go through like the Grove, I had a lot of people that would text, and everyone's always can reach out anytime they want. But we recently added a piece to where we will put could be weekly, bi-weekly, or monthly. As things change, we'll send those updates out and put them in your portal. So little things like that. Property tours, we'll tour both new properties next month, and then we're going to implement just like the post, for instance. We did our initial tour, but then we'll probably tour it as it finishes stabilization too. So we've been doing investor events. We'll have some more of those coming up. The monthly newsletter just started. That'll go out, and then what we're doing right now, we'll have these every quarter. So most likely have these after the quarter, the quarter closes. So these will probably come out similar time moving forward around when you're getting your updates on any, if you're an active in some of the deals. So, and then as we get into these actually backing up a little bit here on what we're looking at, Clayton, you want to just maybe take a few minutes, maybe just give some high level, some of the deals you've seen recently, why they didn't work, maybe some that almost worked.
Sure, yeah. I'll talk a little bit about, I guess, kind of what we did in the end of 25, going to 26 as far as buy box location and strategy, because I think that's a big part of our focus lately. Narrowing down the number of offers we're getting. I mean, we're seeing 100, 200 offers a year come through, and some of these deals are, there's one open right now that's 61 million. They take some time to evaluate. So we obviously don't get to all of them. So our goal has really been focusing in on criteria to kind of pre-screen what we want to see, stuff that already fits our buy box. So there's been a lot of progress on that front. One of the things we've identified, especially in the retail area, are these specific neighborhoods that are above the median income bracket for the state. So we've got some stuff in the works, system development that's happened to kind of help us target and verify those things before they happen. There's been a bunch of, I would say, retail centers built during I want to say 2012, 2015 range, as the economy was kind of recovering after 2008 in a bunch of the neighborhoods, like expanding out from Houston around the outer loops, that just overexpanded way too fast. There's a lot of residential, there was a lot of retail built, but a lot of that retail is not really well occupied. And since then, they've put freeways or interchanges in that make access to those centers very difficult. So you'll see something that's built, in that era, and it hasn't had a tenant the entire time since 2014. There's been a vacant suite the entire time. So on paper, those deals underwrite good, assuming you can, obviously fill the space, but the likelihood of you filling it being vacant that entire time means there's obviously a problem with the marketing itself or the property. And so clarifying some of those things where, all the data supports you should buy something, it honestly takes a lot of time to, validate, physically going to the property, looking at it, what are the hurdles? Why isn't it leasing, And sometimes it is purely operational. Someone's not willing to give, I guess, CapEx dollars, or, not flexible enough. But we've seen more and more of these areas where these centers were never full, and they're nice centers. They have good structure, good value, no CapEx problems, but they're just not at the value they were built at, and they never will be, because the area has already expanded way past them. Certain areas of Katy, especially, where direction change from where it was expanding to, going north instead of west, and completely changed the value of those centers. So it's really made us question, obviously the age gap in the center and why we focused historically on the stuff that's that 2000 and 2008 range, because that stuff is pretty slated. You don't have that over expansion problem in some of these submarkets. But here recently, that's been a big hurdle, just having the time to validate each deal and really trying to put the good deals in front of our faces. And I think, secondly, from a retail standpoint, obviously there's multiple tenants that have, or multiple owners that have these tenants that are locked in for 5, 10, 15 years with zero lease increases. And the downside to that, well, there's an upside and downside. Obviously, the upside for them is that they don't have to worry about vacancy. The downside for them selling it means there's no scalable value there. The value is what it's currently doing. And so if the expectation is to sell it at a cap rate of, whatever the current market cap rate is, the deal physically won't work, from a resale standpoint until 10 years down the road, where you can, swap those tenants out or do something to actually change the value of the center. I would say on a multifamily front, the biggest hurdle we've seen is, I would say, insurance requirements. There's a lot of insurance validation that has to happen. Two of the deals, for example, in underwriting right now are 34 million and 61 million, both located Galveston area outside the Houston submarket, but in the very high end area that kind of ties into the Galveston connector there, like League City. And obviously, you've got all these coastal insurance policies and stuff that are changing that we've historically avoided. And trying to make sure that criteria is hit. And then even on stuff like the Grove, I know for those of you involved in the Grove, there was quite a big insurance list. A lot of these operators, especially in the 1980, 1990 unit era, that they have to repair still, that are massive missing CapEx problems, and they're not always advertised. We'll just put it that way. You've got to do the due diligence and actually find, that value has to be spent, or your insurance policy is going to double or triple, without you being aware of it based on previous T12 statements. So.
Okay. Yeah. Yeah, and to add to his point there, that as many know, like I've had people texting, talked to someone Saturday, I think probably 4 or 5 people in the past week that have capital they're looking to deploy, and why we would love to have somewhere to put it. We will when the deal is right. We're never going to bring a deal out just to deploy capital. We have something closing now that we'd love to 1031 or do something. It's an old land deal that we had, and we don't have anywhere to deploy that capital. So I may deploy that in someone else's, debt fund or something, something short term. So, but we're a deal by deal base. We're not a fund, and we're focused on the right deals. And if that means no more deals this year, or if it means 3 more deals this year, that will just be determined by the metrics and our capacity, obviously. So thank you for that, Clayton. That was great. We'll get in some deal specifics. So I'm going to toss it over to Bailey here, and we'll go through, I think we have 4 on here that we'll kind of just go through and how things are going.
Yeah, thank you. For those of you who don't know me, my name is Bailey. I am the Director of Asset and Property Management here at Fergmar. So thanks for joining today. Kind of talking about our latest acquisition, or oldest acquisition on the new that we acquired kind of in 2025. We closed in August of 2025. For Q1, we've really just kind of honed in on management and kind of dialing on the inefficiencies in which we bought the property. So we've turned 40 units, leasing average of $125 per units across increases. Something really phenomenal that our property management team has been able to hit on is we have been able to obtain 70% of the legacy tenants. And this is really just by actively qualifying residents, enforcing kind of lease compliance across the community due to the mismanagement in which we bought it. That's anything from tenants having to clean up their patios and balconies, making sure that they're following our payment policies. And we've seen a really good turnout for the tenant specifically at this property, really just wanting that management that they were lacking prior in regard to kind of compliance, how they pay, and just the communication from the on-site teams, which has really boosted the tenant retention that Brian was speaking about earlier. The community engagement overall with our referral programs, where we're doing outreach marketing, how we're doing it, and how we're communicating that back to the residents has helped with this as well. So we do have a new management team in place at the post, and it's been extremely successful, as Brian highlighted below. Overall construction project, because we did have a pretty heavy CapEx plan here, all mansard roofs have been completed on site. Parking lot, flat work, exterior carports have been removed. We did complete the pool renovation, landscaping and framing has been completed across all 12 buildings, 13 including the office. And then we are working next on completing final exterior paint. They are working from front to back of the property, and that is almost finalized, with the office remodel as well. Trying to get some additional amenities and kind of support that overall tenant retention where we're holding resident events, and working on track for that. So we are on track currently for stabilization in 2026.
Awesome. Before I go to the next slide, I apologize. I'm terrible at introduction. So thank you, Bailey, for doing her.
You're
So Bailey's
welcome.
Director of Asset Management. She also oversees property management in the sense of if it's third party, she is their direct contact. They report to her. And then we have an internal property management division that we own and operate, and they report up to her as well. So Bailey has spent most of her adult life, I think, in property management. So started with us as a leasing agent, has gone all the way up to take over the property management department, now the asset management department. So Clayton is one of our VPs here. So he handles a lot of stuff like what we spoke on earlier was underwriting. So underwriting, just deal modeling, all the back end, spends a ton of time there, and he's a whiz at that. So apologies for the late intro there. For those of you that don't know them, and you'll normally see both of them on all webinars, including deal specific ones. So that being said, here's the Grove, Bailey.
Yeah, so the Grove is our latest acquisition, 288 units, multifamily, right across the street from our corporate office here in Victoria, Texas. We closed on this just shy of about 3 weeks ago. So we are full steam ahead on our business plan and the execution of that. That includes anything from full construction. That schedule has been launched. Construction was started April 6th. And they are underway with framing and carpentry on the first 3 buildings, kind of working their way back. And then we have a team working from back to front on flat work. This scope includes everything from HVAC installation, foundation repairs, roofing, exterior paint, fencing, gates, amenity upgrades as well. So the property is really getting kind of a full overhaul. Any key amenity additions that we are working on is we will be expanding the gym. It is quite small for 288 units. So that was one of our focus and kind of what we identified going into due diligence. A dog park will be added. There's stations throughout the property, but we're really lacking a kind of specific space for people to be able to use that amenity. So that will be added to the property. We also are adding a covered bus stop amenity for the residents. We do have a high kind of population or family population or demographic who do need this amenity. So we'll be adding a covered bus stop for school pickup at the property, something a little bit different, but that while we were doing due diligence, we felt like it was a need. I drive by the property and there'd be 10 to 15 kids sitting outside in the rain. So because it is across from our corporate office, those kind of little tidbits we were able to learn just by really identifying like what does the property need, what are these people, kind of speaking out about, and then new signage across the property as well for all building signage. Main focus here is really just leasing velocity. We are getting early and strong feedback from the community because of where this sits in Victoria on one of the main crossroads. We really are seeing kind of people noticing the change in the community that goes along with kind of the support on marketing and advertising and how that's helping us as well. So leasing velocity is under full way, just really trying to execute that plan and getting new residents in. As well as resident events. And that kind of goes back to our kind of core value, I'd say, of tenant retention. We'll be doing Meet the Manager events. That's planned for the 30th of this month. Property close celebration, and really just focusing on the residents' needs. Right now, we're very much in construction and heavy kind of deferred maintenance resident phase, just listening to what they need and kind of executing upon that.
Yeah, and the leasing team there, we were able to show the management company there. They used to manage another property here in town called the Aria, which is 250 unit Class A, and their manager that was with them for years. Whenever that property sold, the new ownership just didn't work out. She left there, but they were able to bring her back. So just a phenomenal team that they have there. It's been such a breath of fresh air. The other thing I want to point out here is that full construction schedule. That is, as long as this schedule is met, we will be massively ahead of our projection, our stabilization period there. We had 2 years on this. And this is just kind of how this is, and the purpose of these webinars, how we're evolving. I mean, we have a full in-house construction department. The gentleman that's been running that is now kind of moving more into kind of assisting Bailey on the asset side. But we partnered with they're a national company, but they have a Houston office. They were able to meet or, come in less than all of our, what we budgeted, or we were able to add in some nice amenities with some savings there. But, for them to turn what we thought would be 18 months worth of turn, and they're going to do this, be done by July, is extremely impressive. And I can see it happening. Just the traction since they started last week on construction has been crazy. So,
yeah, I have on schedule to, I'm walking punch outs on building 1 through 4 for carpentry tomorrow. So we're moving.
1 week. So 8 days they did what, in the post, and it's not that the post is behind, the post is on schedule, but we're using local subs. But that's where those economies of scale come in, and we're really focused on that. The post had, say $1 million budget. This is 4.4. So we're able to bring in, and there's still pieces that we will handle if we're, I think we're able to save, $100 and something, $200,000 doing the roofs, locally with a great roofer, and we were able to reallocate those funds to things, like the bus stop, which is one of the coolest things. It may sound so minor, but I think it's one of the coolest things we've ever done for an asset. Just giving the kids somewhere to sit, and just really, again, these are, they're assets, in every sense of the word, but it's a community, and that's what we're trying to create there. So I'm also, if one of y'all would just check the chat, and just if there's something in there, just feel free to interrupt as we're going, if y'all see some messages. So. All right. We will jump into Grand Parkway.
Yeah, and so kind of the final slide here is about our professional center in Grand Parkway. We added about 36,000 square feet. And this was our expansion into the kind of Sugarland market after we already have a property in Cinco Ranch in Katy. So really sole focus here is that we bought the property. It's 15 suites and we have 6 currently vacant. So we are full in leasing velocity. Marketing is live. The team is really pushing hard to kind of fill these vacants and bring traction to the center. That traction, the construction will support that traction because we do plan on revitalizing it as well. So property will get new exterior paint, awnings. We'll do an overall cleanup. The center is just looking a little bit sleepy when we purchased it. Things like grass, who's doing the landscaping, parking lot sweeping really goes a long way. And that's why it's so important about, who we're partnering with. We'll do a vacant suite white box as these needed to be cleaned out. And then we'll have new monument signage as well. So really just trying to bring some additional traction to the center, like I had said. All the existing tenants we're receiving good feedback about ownership transition and the planned improvements. So we've been able to speak and touch every current tenant at the suites in the center there. And then we are planning on just filling the remaining storefronts, completing that exterior refresh, and then kind of building momentum around the current tenant base that is there, as we have some really solid tenants.
Yeah. And both of these, be on the lookout, the Grove and Grand Parkway, we're going to host it'll be for the active investors in the deal, but also it'll be for, any, future or just anyone that's on our list. But we'll host some on-sites there, and should be next month, but we'll get those dates out soon. We're working on that. Okay. And that's kind of, if anybody wants to get involved, most of you are probably on this if you're on this webinar, but, you can join our investor list. You can go to our fergmarcapital.com. You can sign up. You can create a portal login, see anything that's active, and then you'll get, all the communication pieces we talked about earlier. Anybody that, hasn't already had a call, you can schedule an introductory call, or if anyone's I've already spoke with wants to hop on a call again, always, favorite part of my day there. So property tours, like I mentioned, those are coming up, and then future webinars. So we'll keep those coming through.